In this video, we're going to take a look at trends, types of trends. Trends are simply, think of it much like trends in pop culture. Things are tending to go in a specific direction. So when somebody says that a market is in an uptrend, as you would imagine, it means that the market is going up over time. Pretty basic stuff. Trends, though, can also be downtrends. So, for example, this area here on this weekly chart was most certainly in a downtrend. As we were falling, we fell from 138 US dollars to 120 Canadian dollars by the time we got to the downside. But since then, we've been in an uptrend. And that brings us to another possibility, and that would be over here in what they call consolidation. Just means the market is consolidating its gains or losses. In this case, the market had been rising for some time in an uptrend, and then we consolidated a bit, kind of digested our gains, pulled back a little bit further, and then rallied to the upside. Now, the problem with trends is that people will use multiple time frames to define the trend because, why? This is a weekly chart of the dollar CAD, and you can see that we were in an uptrend. Now, we had pulled back a little bit here, but on the weekly chart, this is merely a correction. I mean, you could see that there is still an argument to be made for trend lines being part of the chart. Even with this pullback, we've held the trend line. We didn't break down through all of this previous noise here that had been resisting gains. So that's a correction. It's not a downtrend. This is a little bit more of a downtrend because it was much stronger. There is a little bit of a judgment with this, and that's part of what makes defining the trend a little tricky for some traders. So let me go to the 15-minute chart. Clearly in an uptrend here. Clearly, you could say in a downtrend there, but really, when you look at this fall, you're talking about a few hours. You're talking about 120 pips or so from the very top to the very bottom. I mean, yeah, that's negative, but that's hardly the long-term trend. So when you look at trends, the most important thing to focus on is, I would say, probably the weekly trend, if not the daily trend. There are certain moving averages that people tend to follow. So on TradingView, for example, you could go to moving average, go to exponential, and a lot of times people will use the 200-day. That's because it represents a year of Monday through Friday trading. It goes back to the stock market. And they will follow the overall 200-day moving average. So as we are rising at this point, we're in an uptrend. We were definitely in a downtrend then. You can see that it even offered a little bit of dynamic resistance and support occasionally. So that's one way to look at the trend. Now, there are other moving averages that people will pay attention to, such as the 50 and the 100-day moving average. And they will even extrapolate this stuff down to the 15-minute chart. So, for example, they may take like a 20 moving average, and you can see that that when I put a 20 moving average on this chart here, it moves much quicker on the 15-minute time frame, but it does give you an idea of what the short-term trend is. As a general rule, you want to follow the longer-term trend. You do not want to get stuck in the minutia. So, for example, if you saw something like this on a short-term chart, but we were in a longer-term downtrend, then you think of it more as a correction. You think of this as an opportunity to short from a higher level. You simply must stick with the higher time frames if you wish to be successful. Going back to what I was saying about consolidation and how the market will sometimes digest gains or losses, we could take a look at this level here and this level here, roughly 115 and 114 in the Swiss yen on the 4-hour chart. So you can see for several days we didn't go anywhere, but that does offer short-term trading possibilities. You know that you came in here through an uptrend. Typically, consolidation does mean continuation eventually. But in the meantime, a lot of traders will trade back and forth. Comes down to what style you're looking at. If you're looking for a short-term opportunity, then that may work. Or you just simply look for a breakout of the consolidation that has formed itself, because you can see we continue to go further. If you're familiar with, rectangles, for example, it's the same idea. It basically is a rectangle. Consolidation is just where the market can't go in one direction or the other, but it does typically continue in the same direction it entered. So in this case, up, and of course it did. Now, it works in both directions. Obviously, you can consolidate. This was a small consolidation after a breakdown, and we did continue to go lower. Consolidation just means there is no trend. So you're looking more of a range-bound type of system. You just go back and forth. A lot of times you cut your position size down and just simply scout the market. Now, that is when short-term trading back and forth can be very profitable. But you want defined support and resistance. So in this case, you could say something to the effect of, well, we've hit this line 4 or 5 times. We've hit this line 4 or 5 times. And you go back and forth. You could even choke up on it here and say that we were in even tighter consolidation to kick this off. So again, it comes down to finding places where markets won't go above or below, kind of banging around for small trades, knowing that you're not looking for the world there. And then once you break out of that, that continues the overall trend.